It's Facebook Live, YouTube Live, the World Live. I'm sure there's another widget or gadget out there that I haven't mentioned, but thank you for watching today. We have a great show. I'm Steve Rozenberg. I'm an investor, entrepreneur, speaker, author, vice president of investor education for Mind Property Management. And today on the show is an amazing person. I'm so excited to just dig into her brain that I've purposely not talked to her yet so that I can find it out firsthand. So if you want to know anything about the banking or lending industry and what is going on, you are going to hear about it today with this lady. So I have Christine Beckwith on the show, and I'm not even going to attempt to talk about all her credentials because I will probably mess it up and it will not do her justice. So I'll let her kind of give you the highlights. But what I am going to say is this is a very important subject because this will have to do with many people's livelihoods as to decisions that you do or decisions that you do not make in the future based on what information and intelligence conversations we have today. So if you are watching us and you're somewhere in the world connected to a computer, let us know where you're from. This thing works when we get comments and we get engagement. So Christine is here. She's going to take comments. She's going to talk to us. If she doesn't like your comment, maybe she'll just ignore you. I don't really know. But if you are watching this somewhere and you are in real estate, in finances, in something that has to do with money changing hands, just give us a thumbs up so that we know that you're here and let us know where you're calling from. Because I think it's important that we all kind of engage. This is a very small community, I think, even though as big as Bigger Pockets is and as big as Christine is, I think that this is a very small world. And I think it's important that we all remember that because we all kind of help each other. There's no rule book and there's no playbook that tells us how to do these things. And you just have to learn from people that have either done it or doing it, and they're walking down that path. So again, let us know if, we're here to help you today. I'm here to learn just like everyone else on the show. So make sure that you put your questions and comments in for Christine because I may want to know them and maybe I'm afraid to ask. So I'm hoping maybe someone else does. So Christine, I'll give a quick overview. She is an author. She's a speaker, coach, consultant, a giver. If I were to say all the things that she does, again, it would take me a long time, but she's written books. She's the head honcho of many mortgage industry networks, and she is just a great person. We hit it off right away when we talked. For those of you that have been watching me, Brad Lee was on our show, and Brad Lee is a friend of mine and a very good friend of Christine's. And because of that, he and Zach Connolly put us together and said, you guys got to meet, and kind of took it from there. So Christine, first of all, thank you for your time and being on the show today. I'm very, very pumped about having you.
Yeah, so am I. And thanks to Zachary and Brad for hooking us up because they have such an amazing network that I think it's awesome when I start meeting people that are in their network like yourself. And you and I have a lot in common, and we did hit it right off when we were talking. So no, I'm so happy. Hello, everyone out there. I see the comments starting to roll in, and we can talk about anything that anybody wants to talk about. I don't want to sabotage the opening here. I mean, I'm happy for you to read questions, and I will just tell you that I've spent 30 years in the mortgage industry. I came up through the ranks of origination and management and led two national companies. I was a co-partner at the head of sales in my last company. And in the previous company, which you probably know the name of, H&R Block, I was the senior vice president of sales for the entire mortgage division. I was with them a really long time, started as a branch manager, an originating branch manager, and over a decade grew into higher and higher positions until in the very last couple of years, overseeing 900 originators and 210 branch managers. So hopefully that gives a little context to kind of like where my experience comes from. Yeah. I am all the things that you said now, kind of have dedicated my life now to education and sharing.
Yeah, but I got to say, the one cool thing that you didn't say is that you opened for Gary Vee, right?
Yeah, I spoke for Gary Vaynerchuk which was, and I think one of our listeners, many of my team is probably listening in right now. I shared that experience with Jenna Baggs, who I think is on here right now. So she'll probably write some comments. There's few things cooler in life
I get it. Yeah.
than getting the
cool
call.
to say. I mean, we're in the technology world.
Yeah.
He's got a little name for himself. I mean, it's kind of cool to, I mean, you rub
Yeah.
elbows with some good people.
Yep.
So
I got to speak with him, so it was really cool.
So let me ask you this. Let me ask you a couple questions, and as people ask some questions, we can kind of dig in, because you had a very interesting conversation with a very high up individual, which we'll get to in a minute. But tell me about the mortgage industry and leading up to what we see now. My opinion is that this was not systemic of what is happening now. This is something that was a reaction to the environment. And so where does it go from here? Like, let's talk about getting pushed out of the backside of this and explain your beliefs on that.
Yeah, I mean, I think in order to understand where it's going, we kind of have to really, create some relationship about what has been happening. And you're right. This was not an economic crisis brought on by a failing economy. And so there were things that were happening pre-pandemic in the weeks leading up. And so I guess I'll start there. A lot of people, to give reference, will compare this to the downfall of the mortgage industry in 07 and 08. And, back then, what happened, that economy back then, there were two things that were wrong. And I'm just going to give a little history, then I'm going to bring it forward, tell you what just happened, and then we'll move forward. In 07 and 08, what was happening back then, and understand, here's some reference points. We went from 4% delinquency in 2005, which, by the way, was like the annualized delinquency for most mortgage companies. That's about how many, 4 out of 100 Americans were going to fall on their mortgages. And it rose to 42%. But that was based on two things. Guidelines that had become so loose that there was a rising default market. And there was also a demand issue. And supply and demand does so many things. So supply and demand affects directly like home equity and value. And so if the supply and demand falls and those effects occur, so you had the perfect storm back then, and the government was slow to react. And it took a good long time for that economy to recover, like 6-7 years, slow roll. And we get to where we are now, where we're like full steam ahead and so robust. In fact, the first quarter of this year broke 2-decade records in volume for companies. And there are companies listening right now, I have no doubt, mortgage professionals, where their records are still being broken in the month of April, volume records that have broke historical records, like forever records of these banking institutions. Now, I will tell you that leading up to the pandemic, there was, if you can imagine, and I use an analogy story. So for anyone that coaches with me, they've heard this before. But if you can imagine the risk environment that started to occur with the increased volume in the first quarter. So we were lending as an industry at about 425% volume of normal volume. Right. And so what that means, I say this, if you had a child coming to you for lunch money on Monday and you gave them $20 every week religiously, and then one week they showed up and said, I need 100, would you ask questions? And so I say that because the investors that were lending the 400 and 425% began to do margin calls. And this is kind of like when you leave your credit card when you're out having a night out and the bartender wants you to come back to pay your tab. It's a collateral thing. And so investors started getting service-backed capital, investors began to get margin calls. Lenders began to get margin calls. And so basically that was like saying, okay, Johnny, I'll give you the $100 you want for lunch. But before I do, you're going to go give me $20 out of your piggy bank. But this, to equate it to the banking industry, was in the hundreds, in some cases, of millions of dollars, which stopped everybody in their tracks. That was beginning to happen pre-pandemic.
So this was already, the trend was already, like for you could see a trend already happening here.
We could. And so the government was reacting by lowering the interest rate. And so, there was that Sunday, this is like week 3, right before maybe a week before the pandemic really hit nationally. And the feds lowered the interest rate on that Sunday. If you followed the market, and the whole mortgage industry was left having to explain, where interest rates were that week. And that week got really interesting. And now the news with the pandemic and everything shuts down. What would happen over the next couple of weeks is you would see the job market reports, which is a huge indicator, right, for the mortgage industry, come out. And so just to put it in perspective, pre-pandemic, there were 220,000 unemployed people, which was historically low, so we were so healthy. And then in the first big jobs report, it was estimated the night before by CNN and MSNBC that it was going to be 1 million, which was like, wow. But it wasn't. It was the very first job markets within 7 days of the national shutdown. It went to 3.4 million. And as we know, that has risen in unprecedented numbers. So, I equate it to this. How can investors lend when they don't know whose job is secure? If you're on furlough right now, we don't know if your job will be there when this is done. And so you asked the question, where are we going from here? Well, I can tell you that we're still going to see a low rate interest rate environment when we get back, because the economy, the government's still going to want that low interest rate. So we're still going to be doing refis. People that want to refinance are still going to find low interest rates. That's going to continue. I don't see that changing. However, you might see some supply and demand issue. I follow the Fannie Mae report that came out in April, which was done by Doug Duncan, who is their chief economist at Fannie Mae. And mid-April, and again, it's been a couple weeks, so everything changes, his predictions were still really solid economically in the housing markets. And so what he was saying was we would probably see approximately a 15% reduction in house value, probably by the fourth quarter, brought on by supply and demand. Supply being people that decide, because this became their shelter, they're not ready to put it up for sale.
Right.
And demand being people that decided not to buy because they're afraid of the values of the homes they're buying. So we don't know really what the effects of this is going to be. And we also don't know one other thing. And that is when everybody gets to go back, how many businesses survive. I suspect in 60 days upon the return of everybody to their jobs, we're going to have a much better indication of the damages of this car accident we've been in. Right. And so at that point, we will see stuff. But again, I'm going to tell you, all indicators are for an incredibly robust 2021, low interest rates continuing, refinance continuing. And I think because we're coming from a market that was really robust in an economy that didn't have systemic issues, to your point, we're going to see that recovery occur pretty well. And of course, there's stimulus that is, propping things up. And then there's one other thing. And again, I could spend 10 more minutes on this, but the government stimulus package in the mortgage industry came in the form of forbearance. Forbearance allows people that own homes to skip their mortgage payments. But there's a huge price tag for the lending world for that, because for every payment that a consumer doesn't make, the note holder, the servicer, has to make the payment. And so lenders do not keep that type of capital around. So there's been lobbying. There's recently been some reform. We have news in the last 24 hours from one of the greatest. I got to do a shout out to Barry Habib from MBS Highway, who is like one of the most incredible forecasters in our industry. And really his company is about forecasting. And he literally had a 1-hour meeting with Mark Calabria, who is the government's economist, Federal Reserve. And he literally said that they're probably going to stop the forbearance maybe one more month. But all those servicers that have to pay that money right now, with no relief in sight right now, that the government is not bailing the servicers out yet. That is a huge blow to those lending institutions. So lots of water coming into the boat, very rocky.
So let me ask you this, and I'll bring it down to the investor level, looking at getting a loan or getting a refinance loan. What do you think they're going to do in regards to home equity lines of credits? Are they going to tighten up their lending standards just to make sure they don't put themselves in a precarious position again? Or how do you see that? And if so, any guess how long that'll be? Because you said that it's going to be a good 2021. And what I've always learned is that when it's an election year, like it is right now, nobody wants to go in to get reelected in the down economy. So I'm assuming that the current administration is going to do everything they can to go into the election with a robust economy, which means that's people doing transactions, houses, which means people have to be able to get loans and stuff. So what is your take on that picture?
I mean, I really think that if you look at past economic breakdowns, what we've learned is that we have to be the hall monitors of the lending world. Like the people that run the mortgage companies have to be careful to not allow, the lenders have to make decisions that are based on the risk environment. And the risk environment right now is completely different than it was 60 days ago. 60 days ago, we had the lowest unemployment. Today, we don't know where it's going or who's affected. And so I'm going to tell you that you're going to see, and we've already seen, lots of guideline constriction, which I'm going to say this, and this is hard to say to homeowners. I'm a homeowner too. And just understand, it's like the police showing up at the party for everybody's safety. Like the lenders literally have to protect the economy. If we all don't want to lose tens of thousands of dollars in value in our homes, if we want to come out of this thing alive and not be paying it back for another 20 years, we have to understand that the people getting mortgages right now do not present a risk of default. If we allow risky loans in and that default occurs, those penalties are paid for sometimes at the very desks of the loan officers that are lending the money. In broker's case, it's at the broker desk, but the companies are paying the early payment default and the early payoffs as well. So, that's occurring. And then, of course, with the forbearance threat, it's even bigger. So to say that I don't think the stop sign's up. Like, I think anybody that's in the mortgage industry right now is saying, I'm still taking hands over fist calls. Like the phone's still ringing, we're still doing tons of business. I don't know what you're talking about. And I have a very broad view. I coach for all channels in the banking industry and on the real estate side. And I see it all. And I see the divisions that have been impacted. And no one division has it worse than the other. I get that question all the time. Like, are the brokers worse than the bankers? Everybody's in the same boat because everybody's getting money primarily from the same places. So, there's a funnel effect, obviously. What I would tell you is we haven't seen the effects of this car accident. It truly, in this moment right now, whatever's happening right now, if you're able to get a loan and you like the rate and it saves you money and your bank can close it, because by the way, there are institutions completely not impacted by this. And you might scratch your head as a consumer or an investor if you're listening to this and say, well, where are those? I want to go to those places. Well, those places are the really small places like the federal credit unions and the savings and loan banks, because they're lending their own monies underneath their roofs. And so they're not relying on investment monies. And so they're kind of under an umbrella of protection there, but they're not equipped to service all of American home ownership. They're equipped to service small amounts of their communities. So what I would tell you is, if you have a mortgage officer that you've always used, call that person, him, her, ask, if you're in the middle of refinancing, if, what the rates are. Do I have a prediction of what's going to happen? Here's what I have. I have a big picture overview that interest rates right now this year are lower than they've been in 18 years. So if you mince yourself over an eighth or a quarter and you see this economy flip at some point, you might miss the boat altogether. So I wouldn't get caught in the weeds of, am I getting an eighth better here or a quarter better there? If you like the rate and the payment is good for you, and you can get that loan and close it, take it and run.
So let me ask you, someone asked a question. I'm going to start taking some questions because we're getting a lot of them. So we have Ro Patel says, is there going to be another bubble in the commercial loan market created by the banks?
Yeah, no. The bubble effect that occurred in the last economy truly was on the basis of, inflated values. And so we're not going to have that repeat itself, because here's the difference. We didn't know what we didn't know in 07 and 08. We didn't know we were inflated and that the bottom was falling out. I mean, let's face it, companies like Merrill Lynch fell to this unexpectedly. There was no precursor to what was happening because there was no historical data on as to why it was happening. Today we know. And so let me tell you the way appraisal works, which is your collateral. So the bubble is based upon obviously, the volume going up and us doing tons and tons of volume. I would say we were headed for a small recession. Most economists say that we were in the first quarter when they looked at that, we could see slight inflation occurring, nothing like it used to be. So I think the controls are there to say helpfully no. I think the appraisal process today ensures that and there's a reaction right now to the market in the way that that's even working, that we don't end up in that position again, in that risk position again.
So let's talk about the commercial, because I'm talking to a lot of people, a lot of businesses. I mean, even United Airlines and
Yeah.
even Brad Lee, we were talking, saying, I've got these big office buildings that we're pretty much functioning just fine at home. We don't know if we even need the cost of that. If I own some commercial property right now, I would be getting a little nervous if the people are going to come back to these properties to continue leasing them. What do you see an overall effect of this being a bit of a vacuum out of the commercial industry?
I mean, I think it's truly like we had, again, I'm going to use analogies because I think it paints the easiest picture for us to understand. We had a car accident. So we were racing our cars on a thriving racetrack and a log fell in the road and we crashed into this log. So the difference, fundamentally for us is how fast can we get back to racing? How fast can we get the log out of the road? And what is the real damage to the car? And truly what I think is, if there's people that got hurt in this accident, it's like we're sitting around right now waiting for the emergency, the EMTs to come and save their lives.
We're not even on the backside of this yet. We're not even in the hospital
Every day that goes by, that people are waiting for the ambulance to arrive and it doesn't come. I was thinking the other day, and I don't mind sharing, I'm very analytical and have a lot of peers that are in our space, and we talk a lot about economy. And I was thinking the other day, like, what's happening with all the stores at the mall? Like, go down in your mind, imaginary, go down the mall hall, and you think about, and I'm not going to name brands, but think about all those brands. Every minute that they're sitting without pushing retail out, I mean, they have numbers they need to get every single day. Some of those, we have publicly traded companies that are affected. Like, it's truly, until the pandemic crisis is less of an emergency than the economic crisis. Like, you would think, and I get it, and believe me when I tell you, I don't want to get in a political debate, so I don't want to draw any political conversations into this, and I know that's really difficult to do. You will not hear what party affiliation I am. You will not hear me comment on whether or not I think our president is the greatest guy on earth or not, but I will tell you that, we just don't know yet. And they're still throwing stimulus money. And so is everybody at risk? Is the commercial owners at risk? Yes. I think today, if we said today, everybody could go back to work, you would have however many recover and however many that couldn't financially recover, and they just couldn't hang on. And then in a month or even tomorrow, I think if we said you can go back tomorrow, the difference between who could go back on one day's, like, it seems silly if you're a small, if you have smaller investments, that a day would make a difference. But think about a retailer that gets millions of accounts receivable on a day. Think of brand names like a Starbucks or somebody like that, that's getting, billions in a day. Like, what every single day means to that economy. I think that's where it gets scary. So I would love to tell everybody what to do. What I would tell everybody, my advice, to everybody in investment, is assess your risk. And so, advice when you get in a car accident is get out of the car. And the first thing is, who's hurt? Yeah. I mean, we're doing that, right? As humans, we're looking around our neighborhoods and we're making sure everybody's safe and we're keeping our families safe and we're doing what's humanly right first. But the second part of that is, now let me look at the car and let me see what's done. I run a coaching company that's tied to the national economy because I'm consulting. 100% of my clients are in this economy. Right. And so I created a plan A. So, I have to be the platinum example, right, of running a business. So the moment it happened, and my team will tell you, I created a plan A, a plan B, a plan C, and D. And then I transparently shared what those look like. And plan A was nothing changes. Plan B is, you have this amount of loss and this is the impact, and then C, D. And so I update them in our weekly meetings. We're still in plan A and we've had some losses, but we're still in plan A, and then we've had sales. So you need to assess and you need to be ready to plan for whatever. And you do need to think about what the worst case scenario is right now.
Yeah. And you need to, I completely agree. I mean, you got to have different exit strategies, and I'm assuming you have certain triggers. It's not I'm feeling this way or feeling that way. You probably have some certain financial triggers or numbers, data that's saying, okay, now we're going to plan B. Like plan A is closed. Now we're in plan B, or this is indicating plan D now. So I'm assuming it's not just how you feel that day. It's actually what the data is telling you. And I'm going to keep trying to get to some of these because we're getting a lot of questions. So Francisco Gonzalez wants to know, what is the outlook for the investment property cash out refinance product?
So the cash out refi right now is definitely one of those products that are going to get constricted during this time, because obviously we have a big question mark about the equity position of homeowners. And so, do I think there's some cash outs that are still closing in some lending institutions? There are. And so again, this is another, call your mortgage guy or gal and ask them, what's available. Do I think this product is going to go away? I think it's very likely that the brakes will be on lenders in this product for the foreseeable future. If I was going to make a decision on the cash position I would lend you, if you said your house was worth 1.5 million today, and I was basing it on an appraisal on, May 7th, do I think that the return of that investment or the collateral possibility, the risk, base collateral could collapse? I think it could. And so, I think you're going to see cash out refi constriction. And so what I mean by that is the product may still exist, but you might need a higher FICO score to get it. The product might exist, but you might have to have a lower, loan to value to get it. You might have to have a better debt to income ratio to get it. And so the credit risk position is going to go to a place where it's like, all right, this is really a low risk. They've been in there for a long time and there's equity here, and their payment history is perfect, and they still have jobs and that sort of thing. So yeah.
Okay. And now we'll go to, so these are great questions, everyone. So keep the questions coming. So we're going to keep picking her brain a little bit as much as she'll let us. So Kristen Gleason wants to know, would you be able to talk about the current state of jumbo/non-jumbo conventional loans, and where do you think that's going to go? That's a good question.
Yeah. So that area is the area when I started the economic talk about the beginning before the pandemic stuff that was occurring in the high volume area. This is the arena that got hit the hardest. And so, you have to understand that when you get into jumbo loans, it is the layman theory explanation of this is the guy that has to pay $15,000 a month for his mortgage is far more likely to default quicker than the guy that has to pay $1,500. Because if anything happens in that jumbo arena with jobs, because those are big money jobs, it does not take long for one or two payments to put you in a no ability to pay back position. And so this area is going to be completely constricted. We watched that was the biggest desecration in 07 and 08, the non-prime arena, the no income, no asset loans, the 228s, the prepayment penalty loans, all that jazz that seemed really risky at the time. And those were where the defaults rose. And, I'll say another thing that's happening today that you can make a comparison in. When the foreclosure rate rose back in the prior economic implosion in 07 and 08, 40-something% of the people that went into foreclosure had never had a mortgage late payment ever in the history of their making mortgage payments. What does that tell you? Because I was in that post-mortem examination, executive level, like, why is this happening? And there was a lot happening. First of all, people expected there to be credit reform because it was so widespread. And so people were just like, I'm going to let I'm not going to make my mortgage payment. The government's going to come in and do something. And they actually did. They lowered the 7-year wait period to 4. So there was some stimulus reaction back then to that. But the bigger part of that is happening again with the forbearance thing, because there's a lot of people exercising forbearance that don't need to hold on to their mortgage payments, but are just thinking they have the right to do that because they're in this.
They said they could.
Well, and you know what? I want to be careful about how I say this because I want to be consumer sensitive. And I will say this: if you lost your job, or both of you did, and you have the ability to skip your mortgage payment, even if you have a savings account, I can see the appeal there, because it's kind of like, we're in a crisis, let's hang on to our money. But again, I think that forbearance put our economy at risk. I think the government did the opposite of what they did last time. I think they had too fast of a reaction, and most economists are saying the same. So,
well, do you think it's a case of they touched the hot stove once, so they know what could come if they don't react as quick, so now they're overreacting? And
yeah, I will tell you what I think it is I think it was this. I think if you go back 8 weeks ago, for all of us, it was just about the scariest thing you've ever seen to lead through. Because I don't know about you, but there were a couple of days that I felt like I was in the first 15 minutes of every sci-fi movie I had ever watched in my life. And I was in this house going, like literally like, okay, all right, like, what are we going to do? And so what I think the government did is they could see if they were going to say stay home and don't go to work, they knew what they were doing economically, and they had to have something else to offer. If they're going to hurt you that way, then they've got to have some sort of olive branch on the other side. Sure. And that's what they did. That olive branch was like, look, we understand you've got to stay home because this is a crisis, but we're going to let you not pay your mortgage so that you can hang on to that money. So, it's so easy to criticize leadership. I have this old-fashioned mentality that, if you're a colonel in the middle of a war, I have nothing to say about how you're handling things. Like, these guys are in crisis situations. So I just really feel like it's very difficult for us to say what would have been right or not right. It has an economic effect.
Well, let me ask you this, if they talk about, you repeating your mistakes, and you can look back at history and see, civilizations that have done it over and over again. Based on the 2008, which was an unknown and nobody really knew it was coming. We never saw it. You could have, I guess, if you would have looked at it, but we didn't. Did we repeat anything? Do you think, were we repeating some steps? Because you said that leading up to the pandemic, there were trends and indicators that were giving us signs, right?
Yeah.
Were we actually repeating our mistakes?
I don't know. Again, looking at it, some of the repeat stuff that you would see is we obviously preceding the increase in volume, we're seeing product loosening of guidelines. So, we were starting to do all A non-QM loans again. There were tons of lenders out there. The non-QM was the first area that truly took the biggest hit. And a lot of those lenders are in survival mode right now, where their greatest product, dried up. And that was happening pre-pandemic. So, I think, yes, I think that whenever you see investors having to shell out 400% times the volume, you're going to see fear, and you're going to see some pumping of the brakes. And I think that's where we did learn, our mistakes from the past. We wrote it off the rails in 06 and 07. We just didn't even pump the brakes once, know? And so I think all of what we're seeing. So here's what I want to say is even though, you can't tell where we're going or how much fallout there's going to be or where the job loss is going to end up, and the real impact is right now, we still did not have a systemically broken economy. And so, we are going to return to low interest rates. And that puts us way ahead of where we were in 05, 06, because we'll be moving volume. And so I still think there's a true demand for home ownership that has driven, the building world up in the last few years. And that's been brought on by the millennials. In 2019, the millennials represented 34%. It's the first time that generation ever took the foothold of the greatest amount of homeownership. And it was predicted that this year, they would come back for 45%. Now, economists for 10 years had been saying, here come the millennials, here come the millennials, and they didn't come. And then it happened last year. And so what we know about that is that there is a demand. So will there be a superficial supply and demand issue brought on out of fear of putting your home up for sale or fear of buying right now? I think so. But I do think that that will recover itself faster than a systemic economic break. And when that happens, we're going to see full recovery. And I totally believe what Doug Duncan said from Fannie Mae is that in 2021, we are going to see this thing go gangbusters like it never has. This is what I know about this country, is this country likes to fix itself when it breaks. You have held back an entire world. It's like somebody said it. I'm going to give credit where it's due. One of my good friends, who's also a friend of Brad Lee's, Jay Duran, who's the CEO of Culture Matters, said the effects of this is like a slingshot. And he was speaking generally about businesses. And I think that's a great, great metaphor. We've all been pulled back to hold back. So what's going to happen when we let go? Like, how bad are we going to want to fix everything? Right.
So Scott here asks a question. Scott Forcino.
I know Scott. Hi, Scott Forcino.
There you go. So Scott wants to know, will banks start a foreclosure action when the balloon payment isn't made? And will they accept payments after that miss? That's it.
So it's a great question. We are waiting right now as we speak to hear about the refinance policies for forbearance and balloon. Calabria just said to Barry Habib in the last 24 hours that obviously they're thinking of stopping the forbearance, next month. And so I think we're going to find that answer out. I don't know yet. I do believe that the consumer will not be penalized because of this. So I do believe there'll be credit of reform and guidance given about how lenders should treat the balloon payment. And I'm hearing that many of them are working, just like kind of what we did with the loan modifications. And I know that's a bad word to most lenders back in the day. It will be somewhat like that, where they're going to work on how those balloon payments are recovered. I have heard that a lot of lenders that would have ballooned that payment on the third or fourth month from the forbearance, they are pushing it out to the 12th month. And so not to the end of the loan, but in a way where they're working with the consumer so that there isn't going to be a penalty. And that's really been the greatest fear of everyone, of what's going to happen with this. So stay tuned on that. I'm going to say this: if you're in the real estate world and you are in the mortgage industry, you've got to tune in to 6 to 8 news sources right now that are credible in economics. And there's many, and I'm not going to drop what those names are. But you know who you are. The news stations within our industry have done an incredible job. I've already said Barry Habib and MBS Highway because he's an incredible forecast. He's won the Crystal Ball award twice for economic forecasting. I mean, when Mark Calabria takes your phone call, you've got something right. So I can't say enough about following him. But all the news stations, I make it my job to consume economic news daily, because how am I going to advise all the people that I'm consulting if I can't give? And believe me, nobody's asking me how to run their companies, because they know how to run. All the lenders know how to run their companies. Their executive teams, their board of directors, they know what they're doing. And I think they're all figuring it out as they go. But as it relates to the guy on the ground, the mortgage originator or the real estate broker or the person, that's managing those LOs, I've said one simple thing: don't be the deer in the headlights. I think that when you get those effects where you're like waiting for the other shoe to fall, there's diminishing returns. And I think that there's so much opportunity still for everybody to help out. I mean, these lending institutions, I want to applaud them, because let me tell you what they just did. They all went into their houses and they dismantled teams of 2,000, 3,000 people, 5,000 people. And you know what, guys? They're processing, underwriting, and closing loans from their living rooms across America right now, and they're not missing a beat. These companies are breaking volume records, and I don't know what that means. Maybe afterwards the lenders are going to go, we don't need brick and mortar branches and all that overhead. I don't know, but
so let me ask you this. You said a couple things that I think are important for people to understand, because I have heard many different people give me multiple different definitions of what a forbearance is.
Yeah.
Some people think they don't have to pay the money back at all.
Yep.
Some people think that it's going to be tacked on at the end of the year, some at the end of the course of the loan. Could you just explain to people your definition of what they can expect a forbearance actually is?
Yeah. So I'm going to tell you right now, it depends on the lender that you're with. There are minor interpretation differences. And so if you are somebody that's about to exercise that right of yours, you've got to get informed. So number one, you need to know you are not getting free money. This is not a swap of no payment for nothing. You are moving that payment to some other place in your note. Most of them, are going to require full payment at the end of the forbearance period. So the federal government mandated 4 months of forbearance allowance by all lenders. So they're basically forcing the hand of the lender to offer the forbearance for 4 months, because understand, forbearance isn't something that normally is just free willy to the whole American country. So all these lenders have to offer this. And if you exercise, and you're going to be asked month by month. So I don't think, I have heard of some note holders that were able to say across the boards, like, yeah, I don't want to pay for 4 months, like in one fell swoop. Most service holders, most note holders are going to ask you monthly as you go to make your payment, and you're going to have to opt into the forbearance each time. It will be at the end of the forbearance period. So if you do it for 3 months, you're going to get it at the end of 90 days. If you do it for 4 months, you're going to get it at the end of the 4 months. If you're lucky, your lending institution will allow that money to be put within 12 months of repayment and may work on some sort of repayment plan with you. But I don't believe that's happening widespread. I think most of them are going to require that. So this is what I think is going to happen. I think when you realize that balloon payment is going to come, and I do think lenders are going to be really loud about telling consumers, I don't think consumers are going to get out of this the way they did in 2007 when they went, oh, I didn't know that my loan mod was doing whatever. Or when they, said, oh, I didn't know that, when I did the foreclosure, I didn't make my payment, that this was going to happen. That isn't going to happen this time. They're going to be really loud and tell you, like, you're going to have to pay this back in 3 months. You're going to have to pay this back in 4 months. So I don't think that I didn't know that thing's going to work. I do think that you're going to be offered some form of refinance. But it is going to be subject to your employment and risk-based assessment. And so they're not going to give everybody that, doesn't have jobs and has risk and has problems showing on their credit report a refinance. Right. So you have to still maintain that come hell or high water scenario of your credit. It still exists. We still have to protect our credit. So
this forbearance, I mean, it could be delaying potentially the inevitable, and it could make it worse for people in the certain amount of time, like you said, the 4 or 5 months, that they don't realize. They think, like, I've got a window that I don't have to pay. Because I know, like, a lot of residents, tenants that rent properties, when they say, oh, I don't have to, I get this forbearance for rental payments, and I don't know how that is being handled on the backside, if you're able to tack that on, or the terms of that. I'm not exactly sure what the legislation is on that. But, someone asked a question, number 9, interesting name, number 9. Anyways, number 9 asked, are we at the onset of a foreclosure wave within the next 6 to 12 months? So what you just said tells me we could very well see that wave, which would put us very close. It'll put us right into the election time, right at post-election. It'll put us into 2021, but you're saying that 2021 is going to be a robust year. But
there is enough people buying. So the demand thing comes into play here.
Okay.
There is enough people buying and enough people that will be protected that you have economists still saying, of course, that the rates are going to remain low and that you're going to be in a position going into 2021 where there's still going to be a demand. There's so many factors that could change that. So the answer to number 9 is, are we going to see foreclosure rise? We could, yes. And I want to tell you, the reason you're seeing lenders screaming at the federal government and the David Stevens and the Barry Habibs and the Anthony Casas and all, the Kevin Peranios and all these people that are stepping up and lobbying, with the federal government, is they want them to understand that this forbearance is going to could create that. And with that, every person that goes into foreclosure obviously takes a viable body out of our supply and demand situation. And that is what is the bigger threat to everything that's within our economy. So there are a lot of wait and see things at the moment. And Marco Barrio, you are 100% right. He says, forbearance doesn't modify the terms of your note. That is correct. You aren't getting it is not a loan mod. It is the skipping of the payment. He goes on to say 70% of mortgages are government backed. They've announced they will support either adding forbearance payments to the end of the loan or extending the maturity date. It will be up to each servicer to decide. That's exactly right. Great information. And so, if you're a homeowner and you're exercising, you think you're going to exercise that right, I would tell you this: if you can pay the mortgage, pay it. It's like everything. It's like our mom and dad would tell us to do. If you can pay it, don't skip it.
It's
pay
not
it.
free.
It's not free money. It is not free money. And so, that's it. And even if it's a hardship, but I mean, again, it's been put there for a reason. I do think there is a segment, of course, of our economy that the difference between exercising forbearance or not might be food on the table. And I think if that's true, I completely think this is for you and this is meant for you. And we, work with your lender and get all the facts so that you can figure out how you can get out of this thing, when it's time to get out.
I'd like to know if anyone watching is, and I would like to know your opinion of the short-term rental, the whole, the Airbnbs, the this and that, and I know a lot of people watching are doing these arbitrages and all these different types. Is this a big enough segment to affect lending? Is it that much that it is going to tilt us one way or the other, or is it inconsequential in numbers?
I mean, it could tilt us one way or the other if the Airbnb owners are relying on that income to make their mortgage payments. And so it's, the elbows connected to the wrist type of story, because, one thing is going to, of course, if you own a home that you decided to Airbnb, the rule of thumb is you bought that home to be that mortgage to be paid by you. You're the creditor, and your financial risk position was assessed when you purchased that home. And we said, okay, you have enough money to make the mortgage payment on this house. If you decided to, turn it into an Airbnb and receive that commercial short-term rent or whatnot, and that ended up being, or it's a house you moved out of. A lot of people will move out and think, I'm not going to sell right now. I can't get top dollar. I'll rent it out and I'll do this other thing with it. If you went and bought another house and you were relying on consistent rental money for the other home, and that dries up because we aren't able to go on our vacations, is there going to be an impact there? Yeah, there is. Again, there's a ripple effect with all of this. Here's what I think. I think that every week and month that goes by, this storyline we're talking about right now changes. Right. And I think if you had me on 30 days from now, the historical lessons I've given you will still remain. Right. But my predictions will be what? And I'm cautious that way with the people that are predicting to me and for me and the news, because I know that there's no way that even the president can stand up and make economic promises right now. There's just no way. We want the answers because we want reassurance. Here's what I know. All of us need to do whatever it's going to take the moment that we can to keep our economy alive. I feel a sense of responsibility to help every person in the field that I'm in real estate and in banking, continue to stay focused on doing as much as they possibly can. That's my small contribution to make sure that we, stay alive and we keep things moving. I would ask everybody here, what's your contribution? Maybe you're a homeowner and you can make your mortgage payment and not exercise forbearance. I'm going to tell you, do that. Because every single one of us, every action we take is going to make a difference in this economy. We're either going to fall on the sword or we're going to fight with that sword. What's it going to be?
Let me ask you this, Christine. So when you went through the 2008, like I went through it, and maybe you've been through some others in the past.
Yep. You calling me old right now?
No, I said maybe.
We haven't been funny at all, so I'm just going to let them see my humorous side.
I said maybe. So let me ask you this, what lessons did you personally learn that you have applied and that you are applying and that you're even teaching to other people, saying hey, I walked through this fire personally and this was my lesson that I had personal scars on. What do you have?
So in 2006, I was at the end of a 12-year career with H&R Block Mortgage. It's very public. I don't mind saying H&R Block at the time was a national, obviously international accounting firm, one of the biggest accounting firms in the US. So because it was publicly traded on Wall Street, you could not mess with, chancing where that was at. When I was at that boardroom table, I was with the CEO and the senior vice presidents that were trying to figure out in the months leading into 2006 if we could sustain the company by getting smaller, which was what most national companies were doing. We were trying to get small countrywide. I mean, all of them, right? AmeriQuest, all of them. Option One. I mean, tons of names come to mind.
I've heard those names in a long time. Boy.
I know. Everybody was trying to figure out like how to get smaller, and the big guys couldn't get small fast enough. I mean, we lopped off our foot, so to speak. We closed a couple of large districts down with about 250 originators. When you ask me what I personally went through, what would happen is we would make the decision to close the firm down so that it didn't affect shareholder price. So the whole firm shuts down. It remains in the black. And so me personally, I can tell you that I was working in the great Commonwealth of Massachusetts at the time was the home base for where I was. The Attorney General at that time was Martha Coakley. And Martha Coakley literally began legal proceedings. She was starting to go after mortgage companies. Now, we know she was a voted upon position. Consumers were very unhappy because of the rising foreclosure. And so she wanted to serve some people up on silver platters. And I got swept up in that because I got called because I was an executive, and there were 9 national lenders that were doing non-prime loans in the state of Massachusetts then. And 8 of them had gone bankrupt. And my firm with H&R Block was the only firm that had actually balanced in the black. I got waltzed into a Boston court with literally like 8 attorneys that were sent. And I got deposed, on the basis of like how we lent money and how the credit risk assessment was done. And, I have to say, how did I personally handle it? It was scary. I was afraid that if it was televised or when I was walking in court, journalists were asking questions, that my career was over, that I would be seen as some monger that, helped people get high interest rate loans. And so we were able to shut that down, and she never filed lawsuit and it went away. But during that whole time that was happening, my experience in this industry was really scary, because here's where you go from being a leader, helping people to, oh, there's a criminal implication, to like, there could be criminal, like executives have criminal responsibility in the leading of this. So when you ask me, like, what did I personally feel? Like, I felt it all. Like, I was on that roller coaster, and I didn't miss any of the loop-de-loops or any of the bumps. And what would happen is I would take the summer off when it was all said and done, and I would pick my next gig. My next gig was 13 years. I would find another company, and I would grow with another company into a national lender again. And, I have to say, looking back now, I wrote my first book on that beach that summer. I didn't know I was writing a book. I was just writing to like save my life. I actually was feeling really nostalgic. What happens when you lose a job that you love is it feels like a breakup. And so you end up sitting, and reflecting. And so I had this whole like summer of nostalgia, and I was afraid. I knew it was a historical moment in my life, and I knew it was a historical moment in American economic history. And I thought, if I encapsulate what just happened and I write my book about what made me successful and the whole thing, then I will, and I didn't, again, think I was writing a book, but if I capture it, I'm going to be able to tell that story again. And it's a beautiful story because it, for many, many years was just this wonderful journey. And so now that book is out there. And so I just, I've lived it. I have never had more than a week or 2 weeks off for vacation any year in 32 years. So I have lived through all these different economic stuff, and I love it. I don't like where we're at right now, but I could not see myself not being on the front line of any war. Like, I literally felt like a month ago, like I was waking up in the morning and I had some throwback to back then, to 2006. And I literally was like, all right, let's do this. We gotta go make, we gotta go save some lives today.
Now, and you've written 3 books now, is that correct? 3?
Yeah.
Now, let me ask you this: the everything that you've learned, right? I mean, to the people that you coach and mentor and help, do you walk them through these scenarios, kind of like a sort of basic training, if you will, of what to do, what not to do, how to deal with adverse scenarios like this, and train for this, or do you bring that into the equation with them?
So the only place that I bring in the economic piece of this is when I wrote my base 24 curriculum courses within my virtual training for this coaching company, I kind of built it like a pharmacy. So we have people that are coaching one-on-one with our 9 coaches, and then we do community stuff, and we do group masterminds, and we have all different stuff that's going on. But we have them in Brad Lee's digital dashboard in Lightspeed GT. And, 2020's operated on that. And we do everything. We use everything. It's called Brad's, I'm going to give him a total plug here, but Lightspeed is called the most virtual interactive training system on earth. And so you don't have a tagline like that unless it is. And so we take full advantage of the Lamborghini of training that we have. And, we create social media content curation. We have a reading library. The students are certifying in their courses. And to answer you, yes, I wrote 1 class out of the 24 core curriculum called Economic Advisor. It sounds so simple. And I have to tell you, all my students, many of them had taken that class last year while the market was thriving. And it meant something different. We've been talking this past month, and they all said, oh my God, I'm now reflecting on the class you taught in the curriculum called Economic Advisor. Because in that class, way before this pandemic occurred, I said, I don't know when it will happen to you, when you'll get your story of walking uphill both ways barefoot in the snow, but it's coming. And man, we're giving a whopper of a story to the greenbacks right now. So if you're a mortgage guy in this industry, you just got your snow story right now. You're living in this moment. You've got your war story, and it's still yet to be told. But yes, I say to people in our field, you are an extension of Wall Street. And so you are fronting the 10-year treasury bill for the 30-year fixed. And because that changes every single day, you have to have the ability to speak with intelligence. And I talk about what's in scope and out of scope economically. Now, for instance, I love that you had me on here, and I'm going to tell you why. A lot of times people don't go deep enough with me economically because, I don't know, maybe they think I'm Barbie banker and not someone that really knows what the economics is. But I love that you went deep on this. If you are a person in this world, you have to decide in your business what's in scope and out of scope. And in the banking world, there are a lot of things that are out of scope to talk about with consumers, meaning we don't control market influx. We don't, when I'll give you an example. When President Obama was in the final months of his presidency, he reduced the mortgage insurance premium by 0.75 in February as he was coming out of his tenure. And that increased volume across America by about 40% overnight. Most changes to federal guideline loans would happen with some sort of 90-day notice. He announced that he was going to do this, and then he did it within like 9 business days. What happened as a result of that is the lending institutions across America had massive volume increase and not enough staffing to do it. And the turn times on all those loans went from 3 to 20 something days. And so it affected servicing. That's an out of scope situation, but you still have to answer to the consumer when that effect occurs. So what I try to teach professionals is, what do you control in the transaction and what is out of scope? And so if you've been listening and learning with me and you're running your business in this field, you've already explained to your consumer what you control and don't control. And so I'd like to think that our customers that are working with professionals that are training with my company, they're not getting caught in the weeds and bogged down blame of this current economy. They're just somebody fronting an explanation as to what is occurring and what's happening.
Wow. This is very, very good information. I could talk all day, and we haven't even talked motorcycles because you ride motorcycles also. We haven't even gone down that path, but we'll leave that for another day. Let me ask you this one final thing, and then we'll wrap it up. I know you do a lot to give back. Can you just touch on that a little bit? Because I think it's important that people hear that you give back. You don't just people have a perception of people that are successful. Right. And you and everyone I've ever met that is successful always gives back. And can you just talk a little bit on that?
Yeah. The first way that I started to give back is, my book Wise Eyes opens up. I'm going to get a little emotional. Can I go EQ with you for 2 minutes?
Sure.
All right. So I brought this story up today in a private coaching session with a group of people because people were talking about like how to receive education and learning and information at a high level. And so it was kind of a deep conversation. But my book opens up with a story about my 8-year-old self, my first book, where I talk about how my 6th grade class was holding a democracy and they were doing student council presidency and electives. And we were being taught how the democratic world worked. And I was sitting in the room and, I was trying to decide if I was going to participate, but there was money needed because you needed money for buttons and posters. And I was not in a position to ask my parents for that kind of money. And so I don't know why, but my principal of my school he could tell I was upset. And so he actually came into the classroom after the meeting was over, asked the teacher for me to go to the principal's office, which I thought I was in trouble. And when I got in there, he said, Christine, do you want to do this? Do you want to put your name in? And I told him all the reasons why I didn't. And he looked at me and he goes, I don't think that's the answer. He goes, I think you really do want to, do this. And so the way the story would go is he would talk me into do it and he would coach me through the whole thing. He would literally tell me like, go out during recess and tell all the people what you're going to do for them in the 6th grade. And so I was a little politician out there on the recess with all my friends with posters and all this. And I would win that little campaign. And what that did was set me on a trajectory in life that would make me understand that a couple of things. There were sacrifices I made during that process. Like I didn't play at recess. I was out there pandering for votes. So, there was lessons. And believe it or not, on my little 8-year-old self, I knew what they were. If we think kids are too young to recognize these fundamental things, they're not. And so, why do I teach today when I could be sitting somewhere as a leader in a mortgage industry making way more money than coaching? Is because I fundamentally believe that at the end of my life, I will have changed way more lives this way. And so I've right-lined my wallet, which, whatever, with my purpose. And so I will say this, I started a foundation for secondary education because I had a good friend of mine die of AIDS when we were 26. And I went back and I gave away 20 annual scholarships for college. And then since then, every year I find students in need. So last year we funded a young woman who wanted to make a quest for Miss Teen USA. And she was a shy girl. This was something she wanted to do to overcome some fears. And so we watched her journey. We gave her a full business scholarship to our education. So she had full access to everything that we did. And we did everything, that we could for her. We bought her dresses. We got her, a photographer. And we went and watched her step on stage and compete at the Miss Teen USA pageant. And she did beautiful. But you have to sit in the audience and see like your gift back go into work and know what that means to like an individual life. And so we right now are sponsoring kids that cannot afford college, and they're getting a business education here. They're taking our course curriculum. They're learning how to start businesses. I'm going to tell you, watch out, you college guys, because these guys that are taking my classes I'm giving them the Cliff Note accelerated version on life and business. And I'm going to tell you, they're going to do it in half the time. They're going to come out of this school really incredible. We have a homeless guy, that beautiful kid that is living in the basement of one of his friends' homes, who has been homeless since he was 14. He is this incredible soul that wants to do big things in life and just needed a leg up. He's taking our Tony Geronimo. He is taking our classes right now, and I just know he's going to do big things and whatever. So anyways.
Wow. That is very, very cool. Well, Christine, again, thank you so much for being on today, and everybody that contributed and asked questions. I'm sure hopefully everybody got something out of this. If you did, give her a thumbs up or an emoji or something of a nice emoji, not the other kind of emojis. Yeah, Christine, thank you so much. If they want to find you and kind of look you up, how would they do that?
Yeah. So my website is visionyoursuccess.net. There's so much there. You could spend days. I'm on LinkedIn. You can follow me over there. I am on Instagram as 2020 Vision. I have Facebook groups. Please join my Facebook groups. It's so funny because those groups are really, we put tons of incredible business content over there. And that is the same as my company, as you see behind me, 20/20 Vision, Your Success Coaching. It looks just like the logo back there. For women entrepreneurs, we have a division called Women with Vision, and it is a women's business coaching. We gave awards last year to the 50 highest ranking women in banking. And these women are gangster executives in the banking world. And this year we'll give 100 of those awards out to women that are in the real estate and the banking world. And we have an e-magazine that is coming out Monday called Women with Vision, and then alternate months called The Vision. So please follow us. Women with Vision is the other Facebook group. Ask for membership, get in there, tons of free stuff, and great community. So thank you for asking me, and thank you for having me on.
Hey, thank you. And to Bigger Pockets for both of us. Bigger Pockets allows us to do this. And so if you haven't been on the Bigger Pockets website, I recommend everybody go on there. I'm sure everyone has, but biggerpockets.com. There's some amazing people. All of us do this. We give our time away for free to help educate, and really encourage other investors to succeed. Because like I said in the beginning, this is not a large community as a whole, especially entrepreneurs. And I think this is a way to give back. And that's why I do this. I like to give back because I think it's important to do. And it sounds like you're the same. So I think it's great. So Christine, thank you. Bigger Pockets, thank you. Everybody for watching. I appreciate you taking the time out of your day. Hopefully you didn't have to get out of your day pajamas and you could stay in your day pajamas for the rest of the day for that. So on behalf of Christine, myself, and Bigger Pockets, thank you so much. And we will see everybody next time. I'll be here next week again, hopefully with another guest. I'm not sure I can top Christine, but I'll see what I could do. So thanks for watching, everyone. We'll see you next time.
Thank you.